All right, good evening, Ken of Tortoise Capital Nightly Foundations Q&A for January 11th, 2024. All right, so first question. This is concerning the slope of the RL90, and Jay observes that when it approaches a z-score of 2, that it was a signal in the past for the S&P. It was about to turn south. That's almost true. The fact that it's rolling over, when the z-score is rolling over beyond Z1 is actually the indication. And now it looks like the RL90 is going up, but not as high as the previous high. Does this imply that the short-term market can go higher? But that based on where the RL90 is, the gains would be likely limited. So there's two elements to this question. The first one is the actual RL90. And then there's the z-score of the RL90, of the RL90 slope. So the RL90 is part of our four-part regression line structure, right? So the first one is the RL10 is the price, which we indicate in blue. And then the RL90 is slower. Or the RL30. And we think of that as the health of the trend. And that constitutes the fast pair. Then there's the RL, I should do that lighter green. The RL90, which is the health of the higher trend. And then there's the RL270, which acts as the long-term buy and hold fair value and their trend. So you get a lot of oscillation with the 10 and the 30 as the fast pair. And then the 90 and the 270 acts as the slow pair. And the 10 is the fast and the 30 is the slow in the fast pair. And this is the fast and the slow. But there's also an intermediate pair, which is the 30-90. And this one acts as the fast and the slow. So this is an intermediate term. It turns out that when you are looking at a daily chart and a 3-day chart and a 9-day chart, that on the 10-day, your fast pair is 10 and 30. And then you have the 90 and the 270. Well, if you multiply that daily chart by 3, the 10 and the 30 on the 3-day is the 30 and the 90 on the daily. So it's fractal. So if you're looking at a chart that has all four of those elements on there, and you want to, if you're looking at the daily and you want to see what the 10-30 pair looks like on the 3-day, because it's fractal, you can just look at the current chart and look at the 30 and the 90. So that's pretty important. Now, the z-score is related to the slope of the regression line itself, right? So at any given moment, there's a little angle alpha, and then that has a slope. So we can measure that in terms of degrees, and the higher, the more steep the slope up, the better the trend is, because it's rising faster in the same period of time. So if we take a look back period of something like 180 days or 180 bars, and we compute the angle of the slope for each one of those, and then we find the max and the min and the average and the standard deviation, we can actually construct a little indicator that says if we find the average angle of that slope for the last 180 days and then plot plus or minus one standard deviation, then we would have something like looks like this, where we have if the angle of the slope is better than one standard deviation above average, then that's abnormally good. If it's better than average, but not more than one standard deviation, it's good. If it's below average, but not more than one standard deviation below, it's lagging. And if it's really bad, we might say then it's horrible. And so this is a standard evaluation criteria that we use, right? Well, we can now plot this as a time series. And we can actually track, we can track this as a, I'll just show you the chart. We can now track this as a time series and put the slope of three of those four regression lines on the chart. So in the pale blue, we have this RL10 slope, and you'll notice that it varies quite a bit as it goes through time. So I'm not going to highlight that one that much. The one that's really interesting to me is the black one, which is the RL30. That's the health of the current trend. And you'll notice that that gives a very smooth performance. Like I would like to be able to trade that. And then the insight I had yesterday about the RL90 slope is that one is even smoother. Well, if you track that down to the price action of the last 180 days and you construct the river, the green and the red line creates the river. And I want you to notice that when the z-score slope turns positive, I want you to realize that that is not necessarily the slope of the RL90. It's the z-score slope. So it's the second derivative. And what that's telling you is when this thing turned positive at the zero line, this is the band of normal now. The slope of the RL90 was weakening until it reached this level and then got positive. And it went to the limit of normal at plus 1z. And then it continued all the way up to just short of a z-score of 2. And then it started to roll over and then went through a long period of decay in which its slope got to the bottom of normal at -1. and then continued all the way to minus 1.5 when it began to improve. Now the z-score is improving. The slope of the regression line itself may have been negative. What's important is the improvement. And now what you get is something like summer, fall, winter, and spring. And when it crosses above the zero line, you get back into the summer. Now, why is that important? Because the RL90 is the health of the next higher trend. That's the next bigger pile of money that when they act is coming down to influence our trades and give it a second leg or an extra boost. So we're trading with the 10 and the 30. And every so often, that next higher time frame comes in with their money and adds a little burst. So here's what happened when the slope of the z-score got better. It it was monkeying around here, and then right about here, price got really good. It went from 410 to 460. That was a plus 10% move. Pretty fast. And then when that rolled over outside of the bounds of normal, outside of plus or minus one, that becomes a significant turning point. And that has a smooth and orderly flow all the way down through the zero line, through the minus one line, all the way down to minus 1.5 when it can't get any worse. And it slowly starts to improve. Well, that coincided when you drop that down here. That coincided with the sell-off all the way back to 410. And then when this got better, this went from 430 to 470. So it turns out that the slope of the 90 gives you your directional bias. And more importantly, when you see the turning point, you have a real confirmation that the shape of the market or the seasonality of the market is changing. Now, if you compare this main signal, the confirmation signal of the turning point in the RL90, you'll notice that prior to that, you have a P1 where the RL30 z-score crosses from below to above the slope of the 90. And it peaks right here and then rolls over. And now you get this warning that the trend is changing. Like it warns right in here because you had a nice uninterrupted run, but then it got weak and recovered. That little bit of weakness was enough to start creating divergence in the slope of the RL30 z-score. Well, that's useful to know because now that gave you an early warning, and now this gives you the confirmation. So the slope is still positive, but it's definitely weakening. And you can see that the tactical price that caused things to weaken was here. That's the RL10 slope. Notice how that's getting weak. It hits its natural limit and then is oscillating, and then it's making lower highs. So that's contributing to price slowing down in this region. And then when the RL90 actually rolls over, it's because price is also rolling over. So you get a warning when the RL30 crosses back below the 90. And now here, when this little recovery cannot even get to the RL90, but instead rolls over, it looks like a collapsing dragon. So now you have a clear confirmation, like 1, 2, 3, that this full run up is over. And now what happens? You get about a 4 month horrible sell off from 470 down to 410. That's a 15% sell off. And you will recall that there was a real serious concern when price was here that it was going to drop all the way back to 360. But it didn't. And instead, it made one of the best 40-day moves in the last 10 years of the S&P 500, which you got a warning on. This little bottom, it did not fail. Instead, it actually got better. And that was enough to pull the RL pretty up, and it crossed above the 90. And as the 30's going up, eventually the 90 rolls up. And then now you have confirmation 5 or 10 days later that this is now going to be a nice move. So between these two charts, which are looking at the z-scores of the slopes, you're getting very strong signals and almost no noise. Because remember, we took the individual price bars, 10 of them, and we smoothed that down to a single point on the moving RL10. So we took 10 days worth of fuzzy data and made it worth a single point. So when you have those points of the RL10 projection, you're getting a very smooth and orderly RL10 and RL30 and so on. So I say that to say, what can we learn from this current condition? Well, one of the things we can learn is that the RL90 just confirmed that we made an extraordinary move. And in fact, it's so good that the slope of the RL90 has become abnormally good, which I know because it's above Z1. What does that look like on the actual price chart? Well, if I look on the actual price chart, now we're looking at the RL90 itself and not the z-scores. Now, what you are going to notice here is that if I look at the absolute value of those, this only looks like it made a half a move back up. But what we are concerned about is the angle of the 90. And you can see it's actually slowing down because right here, it was steeply up. And now at this point, it has bent and now it's coming this way. So it's actually starting to slow down a little bit. But it turns out that the steepness of that line is a z-score greater than 1. Means it is still an extraordinarily strong move. But in terms of absolute price value, it has not. Now, this is on AI. So this works on every symbol. Now, when I look at the S&P, the steepness of the market, SPY has been a lot stronger than AI. The steepness of that RL90, which only recently crossed above the slower moving RL270, this is indicating a market that is now believing that it's very strong. This whole period of time in here, there's been a bunch of economic data that looked good, but consumer sentiment was horrible. And the Fed started cutting rates to try to improve perception and to cool down this economy. And it's only now that we're starting to realize, yeah, this is really a pretty good market. But this is happening at the same time that what was a very steep move in the RL30 is starting to flatten out. So what you're having is the RL90 going straight up, but the RL30 starting to roll over. If that crosses here, then you actually have that, you have an RLCO of the 30 compared to the 90. And that means that this period of outperformance, instead of continuing, has began to decay. Now, when it crosses over here, you say, now, much further can this go? Is it going to continue to fail, or is it going to recover and form like a cauda two? Well, we don't know, so we're going to watch. Now, that's, you're seeing the reflection of the RL10s and the prices of the 10, the 30, the 90, the 270. The slope, though, is a derivative of that, and it pairs the slope to all the previous slopes. And what you're seeing there is clearer evidence, according to the slope of the z-scores, that the RL30 has clearly already peaked. It was so strong, it was at 2.5 z-score. Now, that's an extraordinarily steep 30-day move. But I will tell you, if you just look at the price action on that, you wouldn't necessarily know that the RL30 right here is 2.5 sigma better than average of the last 180 days. There's no way you could compute that in your head. So you need the math to tell you. And in fact, the z-score has already come down from its extreme steepness. And even though it's still rising, it's been enough that it has crossed below the z-score of the rising 90. It is already crossed on the z-score. But here's the 30 and there's the 90. If you're just looking at this chart, you don't see that it's a danger yet. But if you look at the z-scores, you see we are in the middle of the danger zone, which means that this whole thing is vulnerable. And if you take a look at the strength of this leg, this is where the RL10 and the 30 were rising, and then it flattened out. And then the second leg of price gets to here, and now pulled back and flattened out, and it's just starting to rise. Notice that the size of this move compared to the size of that move. That first leg was huge. The second leg is half. This third leg is only 1/2 of that. So we're actually seeing energy decline as it reaches that maximum peak, which means that if this RL10 and 30 continue to stall and go sideways, then what you're going to see is the slope of the RL90, instead of being straight up, is going to start to diminish and flatten out and roll over. And then you would see the z-scores rapidly fail. And it's prone to doing that because it's already at an extremely strong reading above Z1. So what does that mean long term? It means that we have an indicator for market classification that nobody else in the world is looking at, and which has been absolutely rock solid in predicting these turning points in the market and allowing us to get the big moves up to avoid or exploit the moves to the downside, and to do an amazing job of calling the turning points with plenty of warning signals. Like when this peaks at greater than 2 and now comes down and crosses the 90 as the 90 is coming out of the normal, this is very vulnerable. And it's a 10% move. If price fell back 10%, then this whole thing would roll over and get back to zero. So we are very vulnerable to a 10% sell-off here, which is $40. By the same token, there's no resistance overhead, so it can keep going, except the all-time high is way back over here. So we're right at the all-time high. So if you needed resistance from pure price, it's there. The Z-scores are telling you that it's vulnerable. It's just had an extraordinary leg up, and this would be a natural place to start seeing a shift to defense. That's what this is telling us. As long as you have the slope of the 30 better than the slope of the 90, you're in good shape. Especially when it turns at an extreme bad, and then you had a long growing season. Well, that growing season is over. That one. Now, could there be another one? Sure. But it's already at an extreme level and it has a lot of resistance to get through. And people have to find reasons to buy it. It was easy to find things on sale down here. When things get to the peak of price, that's where it starts getting harder and harder to find things that haven't been overbought yet. There's a lot of room for growth down here in the oversold, not so much up in here. That's what this Z score is telling us. What are your questions on that one? All right, hearing none. All right. All right, this is let's see who asked this. Kevin. There was a good answer to Hamad on this on a previous session a couple months ago, but I can't remember which one it was. So I'm going to just refresh and do it again. So the setup. So I spent time on stop management, no lose, and not letting a better than average win go below an average win. Those are all true. Yes to Greg's question. In the Kata Challenge course, Griff encourages leaving the stop at the MMRB and exiting at a PSAR flip. And that doesn't resonate with you. At the same time, you don't like to cut a winner short. I think what you're saying is that on the PSAR flip, and if that's your risk box, um, and the move is going up, and then it rolls over, and then the PSAR flips again. That's where he's saying get out. Now, is he saying just leave this in place? And then when this crosses the PSAR, then just take the exit?
That is kind of what he's suggesting, yes.
All right. All right. So that's pretty good and it's straightforward. My preference is to leave this in place here until I get 3 PSAR dots above my entry. And then I jump the stop to the 4th PSAR, and then I follow it with the PSAR. And what gets me out is price. If price goes below the PSAR, I get out. Now, that is true as long as the slope of the RL10 is positive. When the RL10 rolls over, I raise my stop from the PSAR to the upper skin of the dragon. And then I take that, I take that here. And the reason being is that um, I think you could trail with an MMRB if you wanted, and it would follow. And the most you'd ever give back is one wrist box. That gets, in my view, that gets vulnerable in the first 10 bars when you might get a little move that comes down and hits the rising PSAR in the noise box. And then it's problematic to get back in. So you get a lot of decisions. So what I like to do is treat the original wrist box as one solid noise box and just I like to leave the stop at the bottom of that until such time as this thing has moved high enough above my entry that I can jump my stop to no lose plus dinner for two, and then trail with the PSAR. And I'm happy with that as a mechanical approach. Then if I get a special case where the slope of the RL10 has started to flatten out and roll over, then I feel like the move is done. And then I want to accelerate and take the upper skin of the dragon and lock in more of that gain. And this comes down to my observation of how things get started. There's there's like three cases I want to talk about. So you get long here, price came down and then it reversed, and now you get your entry. There are some things, the weak ones that can do this, and then slowly get traction and go. And the idea of the PSAR flip is that that box gives you enough of a buffer so you can tolerate some noise. And it's noise until price goes below this initial stop, at which case, because you had a harsh winter and a reversal in the RL10, you now have a collapsing dragon. And so the signal that says that this move, this hypothetical move, is not working is a violation of the original belly of the RL10. So that makes this whole box noise. So my idea is to leave the initial stop in place until such time as I'm going to just arbitrarily say, let's imagine that this thing gets to 0.5 of that wrist box. Okay. So my entry is here. When that thing gets to 0.5, then I believe that what I can do is get my stop to here. And lock in the no lose plus dinner for two. Because now what I'm saying is I'm taking a plus 0.5 as a signal that this original idea has worked enough that I can lock in a gain. So with this whole idea, this is the Uwe exit essentially. What the Uwe exit does is says, don't until this thing has made an affirmative signal to the upside by giving you half of a wrist box. It's just noise. So there's no justification or need to move the original stop until it clearly gets out of the noise box and gives you enough room so that you can lock in like 0.2. Then if that thing keeps going up, once it gets a full wrist box, I could just trail it with a wrist box or I could trail it with the PSAR and I can live with that. So the first kind of a box that you get is this one where you got a delay and then it takes off. It kind of grudgingly just goes. At the other extreme is that you get long here and this thing has like one, two, two really big moves, and now you're way up here. And the PSAR has barely budged because the last 10 bars were like this, and now it's only bar one and bar two have created this enormous gain, and yet your stop is still way down here. Like you could be up around 1.0. So yeah, what I like to do is I want to know where my average win is. If my average win is 0.7 R, and I'm let's call this at 1.2 R, I'm already 0.5 above my average win. That's half a wrist box. But my actual stop, if I was just using the PSAR trail from the initial, might still be it in the UA exit. It might be here. If I was just trailing with the PSAR from the get-go, it might be here. And I could actually end up letting the 1.2 win all the way down and take a minus 0.8 loss. That would hurt my feelings. So if you get an exaggerated move like that, I will issue a command override on my stop, just move it up and lock in an average win. If I get to 1.2, I want my stop at 0.7 so that I don't let officially an above average win become less than an average win. Right. So my general rule of thumb is, and this overrides any other rules, if I get to 0.7, I want my stop at 0.2 or better. If I get to 1.2, I want my stop at 0.7. If I get to 2.0, I have 3 times my average win. And now I'm going to treat that as a special case, bar by bar, and micromanage the exit because I'm also thinking about adding a second position. So I might take half the trade with the sniper and half the trade with the PSAR. And that way I get a blended exit on things that are exceptionally good, which I define as better than 2. So what could you do? You could use Griff's idea of just leave it, and then when you get the PSAR flip, just exit. That's the simplest. You have one where you could just let's call that the Griff exit. You could just trail the MMRB. What that might do is get you out inside this noise. It's possible. If you trail with the PSAR, it can get you out in the noise before that thing has had a chance to move. So you can just do the PSAR, you can do the UA. To me, the simplest one of all is just price and the PSAR. That's simple. Trailing the MMRB is simple. So I would pick one and try it, but you could also you could take the same case study on the trades that you take and test 4 different exits and for 30 trades. And then just take a look at the histogram of gains of case 1, 2, 3, and 4. And on the basis of evidence, pick the one that resonates with you. Which one do you want? And then adjust your stop accordingly. But that's 4 different exits that you might try. For me, the one that has the catastrophic win, that's one where I just arbitrarily, I just move it up until the PSAR catches it, or until the trailing MMRB catches it, or whatever. I just personally think that the MMRB is so tight that sometimes it can prematurely get you out. But if you know how to re-enter, then that's not a problem. Generally speaking, I think the PSAR, I think the PSAR trail with price, the RL10, if you get one sharp adverse move on price, it'll go down and kick you out 2 or 3 bars before the RL10 can roll over and you get the PSAR. That's the problem on the exiting with the PSAR flip, is that if you get a sharp sell-off for that next 2 or 3 bars, you could lose a ton of money waiting for the PSAR to flip. So my general advice is I keep the PSAR, right? I mean, I keep the stop in place until I get 3 PSAR dots above my entry, and then I adjust it up and then go. And that's good for price that is just monkeying around in here and then goes. But if I see a strong move and it gets past 0.7 and 1.2, I automatically just manually adjust my stops. But otherwise, I will take price hitting the PSAR. And so I can live with an exit that just follows the PSAR all the way up. And then if price ever takes it out, I'm good to go. And then when the RL10 slope goes negative, then I go, instead of the PSAR, I raise that up to the upper skin of the dragon. Because the upper skin of the dragon is always closer to price than the PSAR is. Right? When everything is going well, price looks like that. The dragon looks like this. And the PSAR look like that. And when price looks like this, the RL10 looks like that. When price starts to capitulate, you start getting some sideways, then the RL10 adapts and begins to flatten out. When that flattens out, then I accelerate my stop. Because the dragon will still be is slower to adapt than the RL10. And so then my stop will look like this. It follows the PSAR, and then when this flattens out, I raise my stop to the upper skin of the dragon, and 9 times out of 10, I end up getting that stop. You see it every night on the hybrid swing. We'll just call it the dragon exit. In fact, on the other side, I like that so much that I'm actually starting to use that, the dragon skin, as the entry to go short, and on the bottom side, when there's been a heck of a, and you see this more often on the downside. You see there's been a sell-off, and then this thing starts cruising back this way. It's not unusual to see me take that. See, because this would be the exit. If I was short, this would be the exit. So I'm already stalking this, and I can actually enter right here instead of waiting for the crossing of the dragon. So I'm calling that a dragon skin entry long. And this is the dragon skin exit here. So I actually like trading, if I can, from the southern skin, just as it's turning, to the top of the dragon here. Check or hold. Because I'm front running, Greg. Because I notice things that are extreme sell-offs and I see evidence that it might be changing. And so I'm trying to squeeze every freaking penny I can. Because if this fails here, then I'm back into collapsing dragon right away. I'm experimenting. I'm trying to capture, my whole search is, if that's the RL10, I'm trying to find ways to expand. Actually, I'm exiting right here. I'm trying to expand the amount in the middle I can get. And so to move this down comes at a certain risk. So if I can get it when it enters the dragon, notice that the RL10 slope is already changed. Like I don't get that entry until RL10 has reversed. Then I get that entry. So I'm getting the entry sooner. Come on, tell me drama line. I'm getting the entry sooner, but the slope has already changed. Instead of waiting for here, I'm getting it just a little bit sooner. It's a micro improvement. It's an advanced technique. I do not recommend that you do that until you have 1,000 trades. So, for Kevin, I described 4 different exit strategies. Is that sufficient of an answer?
Yeah, that's great. Thanks.
Okay. So that's where you need to spend your time and effort and analysis, is to find an exit rule, an exit strategy that allows you to just get on with the other cognition, that it's all it has to be is good enough so that you're not overthinking it. You want to be able to commit it to a rule that represents a reasonable trade-off between preserving capital and giving it room to run, giving it room to unfold. So all of those exits that I described are different ways to make that trade-off. And the whole point of converting it to a rule is so that you don't have to think about it on each and every trade, on each and every bar, because that's what wears you out. That's what destroys your span of control. So I'll tell you, just use the damn PSAR. Trust the PSAR is the simplest one. Trust one more time. So if the PSAR is coming down, and then the PSAR flips, remember this PSAR flip box, you should be setting that equal to like a 0.2 of a position sizing risk, so that you're not tempted to exit inside the noise box. And just trail it with the PSAR. And then if the RL10 peaks and it starts to roll over, raise your stop to the upper skin of the dragon. then you capture that extra piece after you've seen evidence that the run might be over. Otherwise, the PSAR is fine. The only time I would override that is if you suddenly had an extreme move early before the PSAR has moved up, and then it starts to decay. And you say, you know what? I am just gonna raise this up and lock that in until the PSAR catches up. And then I'll catch up here. How good does that have to be? At 0.7, I would make sure that I'm at no lose plus dinner for two. At 1.2, I would make sure I was at 0.7. And then I'd let the PSAR take over. 3 minutes. Typically. I use 3 minutes for my intraday tactical. I use 30 minutes for the hybrid swing. Just like I show every night for the past 2 years. Those are always 30-minute bars on the swings, and they're always 3-minute bars on the tactical. Okay, that's everything I want to cover for this one tonight. Get ready for the nightly. Jay, I answered the question that you asked in the first section, so you're going to want to listen to the audio on the replay on this one. That's hung in the foundations course in the usual spot.